So great. So we are looking at IAS 19, and I would want us to move very slowly with this question with an intention of understanding this very deeply, This is an area that can easily this time around, in this case here, save you. That is IAS 19. And of course, if I'm the one preparing for this exam, I'll look at this IAS 19 vis-a-vis what here IFRS 2. IFRS 2, the concept of what here share-based payments. So then straight away, I'll start reading the question. It's here. So when I read this question, that's question number 3. What are they telling me really? With reference to International Accounting Standard 19, employee benefits, briefly explain the accounting treatment of the defined benefit pension surplus, what is also called what here the plan asset in the financial statements of an employer, Really, this kind of a question is not even worth 4 marks. Because when it comes to this plan asset, what are we supposed to do? We are simply, ladies and gentlemen, required here to look at the actuarial valuations. We are supposed to look at the actuarial valuations. Look at the actuarial valuations. Look at the actuarial valuations at year end, at the year end. And remember, this actuary will come and value 2 things. Which are these 2 things? So we have in this case here the plan asset. So the plan asset value at year end, and then of course we have the plan what here. This pension plan has an obligation. The pension plan has an obligation at year end. And then of course you will come and do what here. This is an obligation and this is an asset. So you will deduct. So when you deduct in this case here, then you'll be able to get your net plan asset, or what we call the net plan what here obligation. So when you subtract, ladies and gentlemen, here, then automatically you'll be able to get, in this case here, your net plan asset, or net obligation, which in this case here, net obligation or net liability, call it net liability, which basically will go where, which will go to the statement of financial position, either as a non-current asset or a non-current what year liability. Non-current asset or a non-current liability. So if you wish, you can talk of fair value plan asset, or in this case here, present value of the plan obligations, etc. But the most important thing that you're supposed to know, according to what should go to our statements, financial statements regarding the plan asset. You need to straight pick what we call the actuarial valuations, and this actuary will come and look at this pension scheme that, for example, RCM Online College has been contributing to the plan for the employees. Then, of course, the pension scheme also does what here, goes ahead and invests that money. The pension scheme can never put money in a plan idling. So there will be plan assets. Like if it's a CBK, they have what we call CBK pension towers. You must have seen CBK pension towers when you are around near KRA. You can see how that plan is, or rather that asset is bending, that house. It bends like this, which of course has an inspiration, as I told you some time back. It is bending like this simply because CBK, for their pensioners, they're trying to warn these guys that, hey, you guys, during your prime time right now, try to invest in a pension scheme. Try to look at various stuff that you can do right now when you are energetic, so that during your bending days, when you reach 60, trust you me, when you reach 60, trust you me, when you reach 60 years, trust you me, just Josephine Watamba, trust me, Alicia, right now, I'm so sure you are walking with your neck and head high, but trust you me, the moment you hit 70, hakutakuwa kuslay. Lazima utabenda namna hii. So in short, ladies and gentlemen, the plan must have its own assets. And of course, this plan, given that most of the monies that you have collected today, you've collected this money from youngsters, these young employees. Some of them will be paying them 40 years from today. So you must, in this case, yes, strive to understand what your present value obligation is. So every time you call in an actuary, so the actuary will come and look at this is the pension towers, these are the assets. He'll be able to evaluate them, give you evaluation. And also he comes and looks at he'll be able to, they normally have what we call actuarial assumptions. That a percentage of these employees will be retiring on this year and will be required to pay them this amount. So they pull those cash flows from the future to present value, and then they'll be able to tell you this is the present value obligation. So then my role as an accountant is very easy. The actuary has given me those two figures. What I'll do, according to IAS 19, I'll come and pull them. What the actuary has valued here. So the plan asset at year end, like that. The plan obligation as given to us by the actuary at year end, I deduct like that. Should I get a positive figure here, which is now, of course, a plan asset, then I will be able to pick these and take these to the statement of financial position as what here? As a non-current asset. Should it be negative here, then automatically I should be able to go and book it under the statement of financial position as a non-current what here? Liability. That is the only thing you are required to mention there. Then now we look at part 2. Look at part 2. Please forgive me when I'm saying that you will be bending when you reach 70 and you think otherwise. Don't take offense. Don't take offense. I'm only using those examples here for purposes of ensuring that you guys relate with reality. So we are told here, Roman 2, W Limited, a public limited company, operates a defined benefit pension plan for its employees. The present value of the future obligation, you can see the present value of the future obligations as at the beginning of the year is 3080, and the fair value of the plan asset as at this date is that. So they've given us the asset brought forward and the obligation brought forward. Good examiner. Further information relating to the pension plan for the year ended the 31st December 2018 was as follows. So we have the current service cost, we have benefits paid to former employees, we have contribution paid into the plan, we have present value, benefit obligations as at this date, then we have fair value of plan assets as at this date, additional information, interest cost, which is the gross yield on blue chip corporate bonds, is at 5%. On 1st January 2018, the pension plan was amended. This pension plan was amended to provide enhanced benefits with effect from that date. Remember, this change is made at the beginning of 2018. At the beginning of 2018. So it means that this particular change is as regards to what we call past service rendered to us in the past. Yani tunaangalia wazee tumekaa bila kuwalipa sana, au tumekuwa kiwalipa kitu kidogo kidogo, now we want to make adjustments. Right? So we are adjusting their obligations in light to services that they offer to us in the past. So we call that one a past service cost. So on 1st, please remember we are starting this plan on 1st of January 2018. So at this date, when we had the brought downs, we are told on 1st January 2018, the pension plan amended to provide enhanced benefits with effect from that particular date. The present value of these enhanced benefits as at 1st January 2018 was calculated by actuaries at shillings 100 what year? 10 million. It's a benefit you're giving, fine. But for what we call past service, guys who rendered service to us in the past, we are now rethinking of how do we do what here, make them happier during their bending days, So required, they want us to give them notes to the statement of comprehensive income and the statement of financial position to reflect the financial effects of the defined benefit pension plan in the year ending 31st December 2018. In the year ending 31st December when? 2018. Now, ladies and gentlemen, you must appreciate this thing here. You must appreciate this thing here. You must appreciate this thing here. You must appreciate this thing like this. That in terms of the financial statements, we have known where the plan asset will go as per number 1. But in terms of the financial statements, these are the things that I need. In terms of the financial statement, these are the things that I need, the items that I need. The items that I need, which are very important. Number 1, we'll need what we call the net pension cost. The net pension cost. So this will go to the income statement, to the profit and loss. The profit and loss as an expense, And then number 2, I will need what we call the net actuarial gain or what here somebody loss. So this net actuarial gain or loss, remember this money is now not supposed to be booked into the P&L. So if it's a gain and you book it to the P&L, it would mean that at the end of the day, that gain will be distributed to the pensioners, or rather, if I just explain it in terms of ordinary shares, it means automatically that this gain will be distributed to ordinary shareholders as dividends. And remember, all these revaluations, they may be fake because there are many assumptions that are used to build onto revaluations. So if you remember anything to do with the revaluations, when you revalue an asset, so in this case here, we need to come and do what here? Take this to what we call the OCI. What we call other comprehensive what here? Other comprehensive incomes, yes, down there, other comprehensive incomes. Other comprehensive incomes. Oh, great, we shall overcome. Thank you. Other comprehensive incomes. And then the last item, the last note that I would need, a very important note from you, ladies and gentlemen, now will be what we call the plan asset liability. The plan asset liability. The plan asset stroke liability account. I would need this. Of course, this will go to the statement of what here? Financial position. This will go to the statement of financial position. So then, ladies and gentlemen, where should I begin this thing? Where should I begin working with this entire thing? It's very easy. We normally begin from here. So basically, what we do as an accountant, now you've gotten all that we need. Now we've gotten all that we need to help somebody help that student there. Now we've gotten all that we need. Now we simply need to come and look at the plan asset and the plan liability, those two. The plan asset and the plan obligation. So mention there, actuarial gain or loss. Actuarial gain or loss. Actuarial gain or loss. Actuarial gain or loss for plan asset. For plan asset. Very easy. Actuarial gain or loss for the plan asset. That's where we begin. So this plan asset, I would want to see its profitability. So where do we start from? We start with what plan asset were brought forward to us. Plan assets, in this case here, brought forward. Plan assets brought forward. What is the plan asset value that was brought forward? That was brought forward at the beginning, 1st January 2018. What was the plan asset that was brought forward? What was the plan assets that were brought forward? Plan assets brought forward, we were told up here, 1st January, the plan asset that were brought forward were worth what? Somebody, they are not talking to me this morning. They were worth, in this case here, 28 what here? 2860. Plan assets brought forward 2860. Na unajua, wewe ni mwanafunzi mwerevu, hizi plan assets lazima ziwe na return. Right? hazitakuja tu kukaa hivyo zinang'edhia ati ni assets. Kama ni pension towers ya CBK, we expect returns. If, for example, you have invested this plan assets money, for example, in government bonds, we expect in this case here interest. So in this case here, come and give me the expected, call it interest return. Interest return on the assets, They will give you the rate of return. They will give you the rate of return. They will give you the rate of return. Are you able to see a rate of return that has been provided there? Generally, they'll tell you the rate of return. They'll tell you the rate of return. They'll come and tell you this is the easiest topic. If you don't understand this topic, then you have a problem. So you can see in this case here, it is 5%. It is 5%. So in this case here, 5%. So interest return on the assets. So unadunga 5% of 2860. Please give me a figure very fast here. What do we have? 140 what here, somebody? 143. 143. 143. 143. 143. 143. So I'm trying to look at really what will make these assets here increase in the year. The first thing is that we have invested them. We are getting a return. We are getting interest there. The other thing is that the employer will keep on making contributions. Remember, as an employer, you don't just establish a scheme and then you run away. Every month, you must be making, in this case here, contributions. So you come straight away and tell us there that add the contribution paid, add contributions, add, call them pension contributions, add pension contributions from employer. This increases the assets from the employer. So are you able to see this employer? Are you able to see this employer? Are you able to see these employer assets, employer contributions? So you can see contributions paid into the plan. We have here 259, 259, 259. So in this case here, we have 259. And then now, ladies and gentlemen, remember this pension is a rolling wheel. You are receiving, the guys who are retiring. Even you, trust you me. Right now, you're seeing yourself to be very young, seated next to your colleagues there at the age of about 21, 22. Please start planning for your retirement. And that is why good companies like where I work, in our pay slip, they'll always put, in this case here, your age there, vis-a-vis how many years are left to retirement. Because you shall retire, whether you like it or not, you shall retire. It's a good fact or a bad fact. So in this case here, less benefits. So the benefits we pay to employees reduce. Less benefits paid to employees in the year. Less benefits paid to employees. Less benefits paid to employees. Less benefits paid to employees. So am I able to see the benefit in this case here that were paid to employees? Yes, I can see 242. I can see 242. I can see 242. So please subtract that for me. 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 And then you give me the total now. Thanks, Willie. So it's May 2019, question 3. It's May 2019, question number 3. May 2019, question number 3. So in this case here, they are getting 30, 20, 30, 20, 30, 20. So then, as an account, no, I forgot to ask you something very important. Are we together up to here? Are we trying to follow really? Are we following? Are we following? Are we following? Are we following? Great. Thank you so much. So then as an accountant, this is what I expect to be my plan asset. So in this case here, we have here expected plan assets. Expected plan asset. Expected plan assets from the accountant's perspective. From the accountant's perspective. But now remember, us, we don't have, in this case here, the wherewithal of evaluating these plan assets. So exactly, this is what I expect as an accountant. But in this case here, we have an actuarial valuation. We have actuarial valuation, the guys we trust. So we have in this case here, the actuarial valuation. So this actuarial valuation is the plan asset, carried down. The plan asset carried down. Please, as much as possible, if you want peace of mind, avoid those names I normally see them, you guys using fair value before plan. Why should you use fair value? We know it's just valuation. Avoid those terminologies, fair value, present value, avoid them. Avoid them. So you come and look at the actuarial valuation, So the actuarial valuation is given here. The actuarial valuation is given here as at of the plan. You can see fair value of plan assets at the end of the year. It's the plan asset given at the end of the year. That is what the actuary. Actually, if I'm the one doing this exam and I have my paper, although the examiner does not allow you to write anything, but I should be able to know that the plan, the value is given at the end. Like now, this value given at the end of 31st December 20, this is an actuarial valuation. The same case with this end of the year obligation is an actuarial valuation. So then the actuarial valuation here is 3113. So this is 3113. Now I can see the accountant was booking in this, the actuary has given us a bigger value. When an asset increases, the increase is a gain. The increase is a gain. So in this case here, we have what we call an actuarial gain. So it is 3113 minus 3020, which will end up giving me how much here? A gain of 93. A gain of 93. And then you double underline to scare the examiner. 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 So I've done the actual gain stroke loss for the plan asset. Then straight away, I know as a pension manager, I'm fighting with two things: assets on this side, liabilities on the other side. So once I finish the asset perspective, I'll have to go straight away to the liabilities perspective. I'll have to go straight away to the liabilities perspective. So liabilities perspective. So then you mentioned there the actual gain stroke loss for plan obligation. So now we are doing for the plan obligation. So mention there actual gain stroke loss for the plan obligation. So actuarial. Write the word actuarial nicely, not actual. How could I write it as actual? It's supposed to be actuarial. Actuarial gain stroke loss for the plan, but this time round who? Obligation. So then where do we start, ladies and gentlemen? So of course we start with the obligation brought forward. Where we began from. So give us a plan obligation brought forward. Plan obligation brought forward. Are you able to see that figure? Willy Velma tells me it is 3080. Willy Velma tells me it is 3080. 3080, isn't it? That is what was brought forward. Now from there, you look at, this is quite interesting, the increase that was given to these employees at the beginning of the year, that's also brought forward. So basically come and they give us here, you add past service cost, what we call add past service cost. You add the past service cost. Do you remember that past service cost? I want you to appreciate that this is at the beginning of the year, This is at the beginning of the year. I wish I had the space here. I would have said 1st January 2018. Also, this past service cost change was made at the beginning of the year. So on 110. And then now remember, ladies and gentlemen, that these obligations, when you have this obligation for you, to be able to pay them in the future nicely without issues, you must factor in the issue of interest. You must factor in the issue of what here? Interest. So in this case here, come and put there the interest cost. Now you don't call it a return here. Here you call it interest cost. So interest cost will be 5% on all the brought forwards. 5%. I hope you remember this 5%. Do you still remember this 5%? Do you still remember this 5%? Do you still remember this 5%? 5%. Yes, 5% of all the brought forwards. So I normally see students missing out on this 3080 plus 110. So then what is 5% of 3080 plus 110? Remember, this interest is normally pegged on an amount that was existing at the beginning of the year. At the beginning of the whole, so the interest for the whole year. The interest for the whole year. So then we have, in this case, they are telling me that we have 160 like that. 160. 160. Then, ladies and gentlemen, remember that these guys, or 159.5, 159.5, 159.5, 159.5. So then remember that these guys, for their current services they are rendering to us, we have an obligation. We have an obligation that we must book in. They are serving us as we speak. Some of you have even written to me and say that, you know, Mwalimu, what? We are stealing our employer's time. We're watching this while still working. So you are rendering some current cost, some current service, and therefore there should be a current cost which should be taken to our obligate so that in the future we are not caught up. So in this case, here you'll come and add current service cost as an obligation, current service cost. So the current service cost, are you able to see the current service cost in the question? Are you able to see the current service cost in the question? Are you able to see the current service cost in the question? Current service cost 209. 209. Remember, the current service cost is evenly distributed in the year. So please, the current service cost should never be part of the interest cost. Interest cost, we knock it against those things that started with us at the beginning of the year. So on a summary 209 like that, 209. So ladies and gentlemen, of course, this obligation reduces with the benefits that we pay. So less benefits paid, less benefits paid. So we less the benefits that were paid. So less benefits paid. Do you remember that figure that we got? Do you remember the figure that we got as a benefit? We used it up there in the plan asset. In the plan asset. So then this is giving us 242. This is supposed to be a deductible. And now that marks the end of my work as an accountant. So we have here the expected obligations at a year end. Expected obligation. Expected obligation at year end. Expected obligation at year end. Expected. So please take this, all of them, and then you subtract the 242. 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 So according, in this case here, to this lady called Elizabeth, and I said 33, 16.5. Thank you very much. So this is what you expect as an accountant. As an accountant, this is what you expect. All right. So of course, in this case, now we have the bigger man in the equation. We have the bigger man in the room. This bigger man is the actuary. So then we have the actuarial. So we have here the actuarial plan obligation at year end. At year end again. So this guy, how much is he valuing this thing at? So it is 33 what year? 60. These guys are not seeing this figure at the year end. At the year end, the actuary is giving us this at the year end. At the year end, the actuary is giving us this at the year end. At the year end, the obligation is 3360. 3360. So then we have here 3360 like that. So in this case here, an obligation has increased. When an obligation increases, is it going to be an actuarial gain or an actuarial loss? I can see the obligation has increased from here to the 360. Has increased. Is a loss, isn't it? So then we have here actuarial loss actuarial loss because obligation has increased of 43 what year? 43.5, like that. 43.5, 43.5. Great, 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 great. Now from there, now we start doing our what year? Those three accounts, the three accounts. So now we shall start doing our three accounts. Which three accounts are these? Our three accounts, the three musketeers, the three musketeers, the three musketeers, the three musketeers, the three musketeers. We start with the first one, which is the net pension. So three musketeers, three cuts. Let me call them three cuts, three cuts, three cuts, three accounts, very important for us. So the first one is the net pension cost. The net pension cost, which will go to our P&L as an expense. So the net pension cost inajuanga sana. Nakuja hapa kwa plan obligation. Hii cost easy. Unaona hii? Cost easy. Cost easy. Tatu. Hizi unachukua. Hizo unachukua. Unaanza na first service cost. First service cost of 110. Then we have in this case here interest cost of 159.5. And then we have a current service cost, current service cost over 209. But again, remember, this is like a small income statement. Adjust the board. The board is not very good. The board is not very good. So this is very easy. Once I have these three, then I'll come and less the interest return. The interest return on plan asset. The interest return on plan asset. Are you able to remember? Are you able to remember? Poor network. Is my network very poor? Are you guys able to see? Are you guys able to see? Okay, okay. It's okay. Thank you very much. So are you able to remember that we got some return, interest return from the plan asset? Can you go there and pick that figure? Can you go there and pick that figure? Can you go there and pick that figure? 259? Is it 259? Let me see. Let me see. Let me see. The expected interest return. It was 143. 143. Just check, check, check. Remember, because we are calling it a cost, this now will be what here? A negative figure because you're subtracting. No, this is just a joke. I'm calling them cuts for the cuts in the pension scheme. The cuts, the three cuts. So they come and deduct. So when you deduct, you'll be able to get the net pension cost. You'll be able to get the net pension cost. So net pension cost, Shigana. Wait, they're not talking to me. You take this, you subtract this, you give me a figure very fast. You give me a figure very fast. Give me a figure very fast. Give me a figure very fast. So according to this gentleman, they are getting 335.5, like that. That is the first cut. The first cut, we've been able to bear the first cut. Net pension cost. From there, you go to this other one, which is very easy, number 2. So number 2, now I can rub even this. Now I don't need this. I don't need this, although I still need it. Number 2, we have the net actuarial gain. Net actuarial gain stroke loss. Net actuarial gain stroke loss. Remember, you had this actuarial losses, this actuarial gain, the actuarial gain, and we had the actuarial gain on asset mentioned there. Actuarial gain on asset. Do you remember that actuarial gain that we got? Actuarial gain that we got is 93. And then we have actuarial loss on the obligation. Actuarial loss on obligation. It's a loss of 43.2. It's a loss of 43.2. It's a loss of 43.5. So loss you're subtracting, and then now you should be able to give me the net actuarial gain. It will be a gain. Net actuarial gain. Net actuarial gain. So the net actuarial gain, what figure are we getting here for the net actuarial gain? We are getting 49.5, 49.5, 49.5, 49.5. And then now the last account there, is the net pension asset stroke liability. Net pension asset stroke liability. So we have here the net pension asset stroke liability. The net pension asset stroke liability. So we have the net pension asset stroke liability. We have the net pension asset stroke liability. The net pension asset stroke liability. So the net pension asset stroke liability, this is the easiest. Remember, you had the actuarial valuation of the asset. So we have here actuarial asset valuation at year end, asset valuation at year end, and then we have actuarial obligation, obligation valuation at year end. Are you able to remember these figures? For example, these I can see it here, actuarial plan obligation at year end, 3360. 3360. How about the other one for the asset? Is there somebody who can remember for the asset? Actuarial asset valuation at year end. Is there anybody who is able to remember this? Is there anybody who is able to remember this? 31, 13. So we have here 31, 13. Thank you very much. So then come and give me, in this case here, the net. So the net, what do we have there? So the net, of course, I can see the liability is more. The obligation is more. So it will be a net what here? It will be a net pension liability. A net pension liability. A net pension liability over how much when you subtract? It will be a liability because the obligation is more. The obligation is more. 247, like that. So it's an obligation. And now that marks the end of that what year particular session. So because I've never done this pension question and put it in my YouTube channel, I'll be able to hang this there. And of course, as usual, you guys have always given me support by putting thumbs up there. And of course, subscribing, isn't it? Great. So